Autolus Therapeutics, ticker AUTL, delivered a massive Q2 beat across the board today. EPS came in at a loss of 15 cents, which easily beats the consensus estimate of a 21 to 23-cent loss.
Yeah, and net product revenue just absolutely crushed expectations at $45.7 million.
Right, that is a 119% year-over-year increase.
It's massive, and management aggressively raised their full-year AUTL DCZYL revenue guidance to a range of, $140 to $150 million.
Up from 120 to 135 million, which the market obviously loved. The stock reacted immediately, surging over 11% into the $2.30 range on really heavy volume.
So zooming out for our deep dive today, our mission is to look under the hood of these numbers because there's a central paradox here. We pulled the full stack of Q2 earnings reports and analyst notes to figure out how a biotech company can double its revenue, flip its profit margins, and will still need to lay off 13% of its workforce.
Yeah, if you were just looking at that 11% stock pop, you might think Autolus is completely out of the woods.
Yeah.
But I mean, surging top-line revenue doesn't keep a cell therapy company alive.
No, it really doesn't.
The real fundamental shift happening here is the unit economics. Specifically, this gross margin flip. In Q1, their margins were sitting at a dismal 6%.
And they were actually negative throughout 2025.
Right, negative in 2025. But now they have rocketed to 55% in Q2.
It's a huge step up. Management is even targeting peak margins of 65 to 70% down the line. And, this margin inflection makes total sense when you understand how their specialized CAR-T therapy is actually made.
Yeah, because creating a bespoke cell therapy is not it's not like running a traditional pharmaceutical assembly line.
Not at all.
Think of it more like a massive workshop for high-end bespoke tailors. For a long time, Autolus was paying for this enormous facility, keeping the lights on, paying highly trained staff, just to produce a few customized treatments a month.
Exactly. And now that they have hit 82 U.S. authorized treatment centers.
Which beat their year-end goal of 80 early, by the way.
Right. They beat it early. So the volume is finally pouring in. The fixed cost of keeping that bespoke workshop open is suddenly being spread out across many, many more treatments.
Allowing economies of scale to instantly ignite profitability per unit.
Yeah. And we're seeing the mechanical results of that scale at their UK manufacturing facility. They didn't just scale up production, they actively drove down the manufacturing cost per batch.
Oh, wow. How do they manage that?
By optimizing the actual biological batch processing. They're wasting fewer raw materials, they're getting the engineered cells back to the patients more efficiently, and significantly reducing their inventory reserves.
Wait, I am stuck on something here.
Sure. What is it?
You're telling me gross margins just ignited to 55%. Usually when a company proves their unit economics work that well, they go on a massive hiring spree to capture market share.
Usually, yeah, they do.
But like we mentioned at the top, Autolus is executing a 13% workforce reduction, and their SG&A expenses still jumped to $41.2 million. That just doesn't add up.
Yeah.
Are they bleeding cash somewhere else?
Well, the harsh reality of commercializing cell therapies is that building the sales and delivery infrastructure is incredibly expensive.
Okay.
Yes, the unit margins are up, but the company is still operating at a $43.8 million overall quarterly loss. Furthermore, if you look closely at that raised revenue guidance, it actually implies a flattening revenue run rate for the second half of the year.
So they are hitting a ceiling.
Potentially. It points to seasonality or, honestly, more likely capacity caps at those actual treatment centers. I mean, they are aiming for 90-plus centers by year-end, but rolling those out takes capital.
Which explains the debt. They did just secure a new $250 million credit facility, right?
Yeah, they did. That extends their cash runway into Q2 2028. But because of these heavy infrastructure costs, analysts have actually pushed back their long-term profitability forecasts.
So if you're holding this stock, that is the friction point you have to weigh. Their primary treatment for adult acute lymphoblastic leukemia is generating great cash right now.
Right, but those specialized treatment centers can only handle so many patients at once.
Exactly. Which brings us to the real valuation wildcard here. They're pipelined in a product strategy.
Oh, absolutely. They're planning to take this exact same CAR-T platform.
The same one they just proved they can manufacture at a 55% margin.
Yes, that exact one. They want to apply it to autoimmune conditions. We are talking about massive, broader markets with critical data readouts for lupus and progressive multiple sclerosis on the horizon.
I mean, if that bespoke workshop can successfully pivot from rare leukemias to widespread autoimmune diseases, the revenue ceiling completely changes.
It is a totally different ballgame at that point.
Definitely something to ponder as you watch these numbers stabilize over the next few quarters. Remember to follow the show for your daily earnings coverage.